Sideways markets, consolidations, ranges, we've all been there, right? The price just chops back and forth, and it feels like every single trade you put on is a loss. Honestly, it's probably the #1 way traders get chewed up and spit out. But what if I told you that this price action isn't random at all? What if it's actually engineered? Well, today, we're going to pull back that curtain and show you exactly how to trade these tricky markets like the smart money does. Welcome to AI Explains ICT. In this video, we are diving deep into ICT's core content, specifically from Month 9, Episode 4, which is all about mastering consolidations. This is a game-changing concept, so let's jump right in. So here's what we've got on deck. First, we'll break down the consolidation trap and why it's so dangerous. Then, we'll look at the two totally different mindsets for trading it. After that, we'll find our directional compass. This is crucial. Then we'll see how to trade against the crowd, and finally, we'll wrap it all up with the complete smart money playbook.
Okay, so what is a consolidation really? On the surface, it looks like the market is just bored, stuck in a range, going absolutely nowhere. But underneath all that quiet, something massive is happening. Orders are building up, a huge stack of buy stops above the highs and an equally huge stack of sell stops below the lows. This creates these giant pools of liquidity that act like a magnet for price. Now here is where your entire perspective needs to shift. We're all taught from day one to buy breakouts and sell breakdowns, right? That's trading 101. But what if that's a lie? What if those moves that look like powerful breakouts are actually just sophisticated traps designed for one purpose? To take your money and fuel the real move in the opposite direction. To really get this, you have to see the market through two completely different sets of eyes. On one side, you've got your typical retail trader's logic, and on the other, you have the smart money logic. They are playing two entirely different games on the very same chart. And look at this. It's a night and day difference. Retail logic is all about reacting. They see price moving up, so they chase it. They see an old high, and they sell it as resistance. Smart money, though, they're proactive. They fade those breakouts because they know that's where the liquidity is. They wait for price to dip under an old low, right where everyone's stop losses are sitting, and that's where they buy. They sell above the old highs, right into all that excited retail buying. It's completely counterintuitive, but it's how the game is played.
And this quote from ICT just says it all. Smart money isn't just sitting back and waiting to see what happens. They are an active force. They will either let price run to a key level to trigger all those stops and then fade it, or they'll be the ones who actually engineer the move in the first place. They aren't following the price. They are participating in its creation.
So you're probably thinking, okay, if breakouts are traps, how in the world do I know which way to trade? How do I not get faked out? And the answer, the key to everything, is your higher time frame directional bias. This is your compass. This is what keeps you anchored when the lower timeframes get chaotic.
The principle is called order flow subordination. And it's a simple but powerful rule. It just means that whatever shenanigans are happening on the 15-minute chart, they must eventually respect the direction set by the daily and the 4-hour charts. Think of the higher timeframes as the big boss. They have the final say on where price is ultimately going.
So the whole process boils down to these 3 simple steps. Number 1, and this is non-negotiable, you figure out your bias from the daily and 4-hour. Is institutional order flow bullish or is it bearish? Step 2, you drop down to a lower time frame and you spot a consolidation. And then step 3, this is the magic. You view any move that goes against your higher time frame bias not as a change in trend, but as a deliberate grab for liquidity. It's an opportunity.
All right, now that we have our compass, let's look at the actual tactics. Let's see exactly how smart money uses this knowledge to trade against the crowd and profit from these so-called breakouts. This is where it gets really fun.
Okay, let's walk through this. Imagine our higher time frame bias is clearly bearish. The market is supposed to be going down. Then, on a lower time frame, price consolidates and suddenly breaks above an old high. What happens? Retail traders get excited. They see a breakout, they pile in, hitting the buy button. But we know better. Because our bias is bearish, we see this for what it is, a stop hunt. And smart money uses all of that frantic retail buying as the perfect liquidity to sell into, getting a fantastic price for their short positions.
And here's the exact opposite scenario. This time, our higher timeframe bias is bullish. We expect price to go up, but then price breaks below a consolidation low. Retail traders see this as weakness. They think the market is crashing, so they start panic selling or going short. But smart money?
They see a fire sale. They see a raid on sell-side liquidity, and they happily absorb all of that selling pressure, loading up on their long positions at a deep discount right before the real move up begins.
This same logic works even inside the range itself. If the market is bearish on the higher timeframes, smart money is looking for price to expand upwards, away from the middle of the range, or the equilibrium. When price rallies and punches through a short-term high above that midpoint, that's the trigger. They sell that little rally, fading the expansion because they fully expect price to reverse and go hunt for the liquidity that's sitting below the range.
And conversely, in a bullish market, they do the opposite. They patiently wait for price to expand downwards from that equilibrium. When price drops and takes out a little short-term low, they don't see weakness. They see a run on sell stops. They see an opportunity to get long. So they buy that dip, anticipating the real move is coming, a run for the buy-side liquidity resting above the top of the range.
All right, let's put it all together now. We've talked about the theory, the mindset, the different tactics. Let's distill all of that down into a simple, clear, actionable playbook that you can start using in your own analysis.
Here it is, step by step. First, always start with your daily and 4-hour order flow bias. This is your North Star. Second, mark out your consolidation range and find its midpoint, the equilibrium. Third, and this requires patience, you wait for price to expand against your bias to go hunt for liquidity. Fourth, that liquidity hunt, that's your green light. That's your entry trigger to get into a trade that's going with your bias. And finally, number 5, a great place to set your initial profit target is right back at the equilibrium of that range because price loves to gravitate back to that fair value area.
So I'll leave you with this one question. The next time you see a market going sideways, just ask yourself, are you chasing price like everyone else, or are you waiting to engineer liquidity like smart money? Thinking about this one question can fundamentally change the way you see and trade the markets.
Hey, if you found this video helpful and it gave you a new perspective, do us a favor and hit that like button and subscribe to the channel. And if you have any questions at all, just drop them in the comments below and a real human will get back to you. Stay safe out there and happy trading.